Good afternoon, good evening, good morning, wherever you are. Welcome to this month's presentation by Valutrades, our usual webinar, and it's a special one this week. We're going to be looking at Fibonacci retracement levels. If you're new to trading, you probably hear a lot about Fibonacci. If you're a seasoned professional, hopefully I can give you some pointers as to what to look for in the markets. And there's a few things that you may or may not know about Fibonacci. It's quite an exciting tool that we use in professional trading. So let's get going. Right, my name is Brad Alexander. I've been working with Valutrades for a number of years now. If you get the chance to see my videos on Monday mornings and Tuesday mornings, you'll find that the Tuesday morning ones, which cover technicals, we look at Fibonacci quite a lot. So this may help explain a few things if you're not clear on what's going on with Fibonacci. My day-to-day role in my company, my business, besides being a retail and professional trader, is to provide content. So I'm always looking at the markets. I've looked at, worked for brokers. I'm an educator. I have classes and students. I work for fintech companies, so I have the wonderful sight of being able to see the industry from all different angles. And I'm a platform junkie and I'm an indicator junkie. So I really enjoy getting involved with things like this. And I really enjoy reaching out to good people like yourselves, learning traders, beginning traders, intermediate traders, and helping you along the way. So if you have any questions, please feel free to ask as we go along. Right, we have to say though, even with Valutrades and any broker, CFDs are complex instruments and come with a high risk of losing your money. 61% of the Valutrades customers lose money when trading CFDs, which is very good. I work with a lot of different brokers and I see a lot of disclaimers, and 61% is actually quite a good number. So let's try to have you guys on the other side of where you're making money. You should consider whether you can understand CFDs and how they work, and FX, and whether you can afford to take the risk of losing your money. Losing money in forex is generally not about bad luck or not understanding the markets. It's about risk management, and one of the things that we like to stress in our risk management is having a plan, whether using Fibonacci or any other indicator, and as well, of course, looking at your position size. Position sizes can blow up your account quite easily. So let's get going with our Fibonacci webinar. Please take a look at the disclaimers on the Valutrades website to make sure you totally understand what you're investing and where your risks are. Okay, the agenda for today's webinar, we're going to look at, again, Fibonacci. So who is Fibonacci? It was actually a name of a person. We'll go into that in a few very short period of time. So what is Fibonacci, and what do we do with it, and how does it work? But more importantly, why? Not so much why do we use it, but why does it work? And you'll probably find the answer to be quite fascinating. Fibonacci is really not anything more than plotting levels of support and resistance. It is very often called an indicator. To be technical, pardon the pun, it is really not an indicator, it's a graphic. It's actually a graphic element that we can draw onto our charts to plot support and resistance. I like to look at technical analysis in many different ways, and there are very many different ways of using technical analysis. If you follow my videos or have taken any classes, you will know that there are a myriad indicators that are mathematical, like Bollinger Bands and stochastic oscillators and MACD. There are other indicators like chart patterns, where we physically draw triangles and pennants and double tops and double bottoms. This is different from the indicators, of course, but it is still technical analysis. I like drawing patterns and chart patterns because it reflects the mood of the market. It's a graphic representation of what the market is thinking. You've got battles between buyers and sellers, and chart patterns can easily show this up. You have candlestick patterns, which can also do the same thing in terms of indicating the mood of the market. We'll go into that in a different webinar. And then you have Fibonacci. Fibonacci is sort of out there on its own in terms of it's not based on the mathematics of the actual pricing and actual trading. It is basically a graphic element that looks at retracement on trends and other things. So let's go into what that is. I'm going to show you as well. You may have seen Fibonacci retracements many times and used them many times. There are other types of Fibonacci graphics that you can use. I'm going to be looking at that in a few minutes. And also, and if you watch my videos and take my classes, you will know I pound and pound and pound. Don't just trade with one indicator or one graphic or one method. You need to combine elements together. So using Fibonacci on its own may or may not work for you, but if you combine them with other indicators, you will find that you have a higher rate of success and be on the side of those who are making money and not losing money. So Fibonacci on its own is not the be-all and end-all. And in fact, and like any technical indicator, like any technical strategy, it is technical. And I always encourage every trader, especially beginning traders, to look at the fundamentals first. So getting back to the Valutrades Market Blast, we do Monday mornings fundamental analysis, Tuesday mornings technical analysis. Every trader in the world worth his salt will take the fundamental analysis first and then look at the technical analysis. To give you a prime example, there's no point in looking at Bollinger Bands and stochastics or MACD if there's a war breaking out in the Middle East or there's a sudden flare-up in the US-China trade relations. The fundamentals will always win. And it's the same with Fibonacci. You need to be aware of what's going on in the world before you jump in and start trading bounces off Fibonacci levels. Okay, then we're going to be looking at some practical examples, and we're going to be taking some current charts on the Valutrades MT4 to see what Fibonacci can do for us and how to combine them with other indicators. Okay, so I said, who is Fibonacci? Well, here I've drawn a bunch of rabbits. What does that mean? What has that got to do with trading? Well, Fibonacci was an Italian mathematician from the 12th century. He was born in 1170 and died in 1240. I'm not going to spend too much time on the man himself, but he was a genius. He was a beautiful mind, and he lived and breathed mathematics. And the reason we've got some graphics and rabbits on the chart on this slide is because he was tasked with the task of finding out, let's say, how many rabbits will be in a field if they're left to multiply. And rabbits in those days could be destructive to a farm. So invoking mathematics into farming was not uncommon. It still isn't, obviously. So what does that have to do with trading? Well, looking at this, rabbits and other things around in nature, Fibonacci discovered what we call now the Fibonacci sequence. And simply taking a series of numbers, so starting with 0 and 1, add the number before it, so 0 plus 1 equals 1, add 1 plus 1, we get 2, add 2 plus 1, we get 3, add 3 plus 2, we get 5, 5 plus 3, we get 8, et cetera, et cetera, et cetera. Well, so what? What does this have to do with trading? Well, Fibonacci found that this sequence of numbers repeats itself over and over again, many times in nature and in life. And he took that a step further, and he discovered Fibonacci ratios. So the ratio of 2 to 3, 3 divided by 2, 5 divided by 3, 8 divided by 5, et cetera, et cetera, et cetera, created interesting ratios. And if you express those as a percentage of each other, you get what we call, again, Fibonacci ratios. And you're going to see them very quickly as we get going into our webinar. And again, you're going to be asking, what does this have to do with trading? So if we look at Fibonacci retracements, we can start at 0. Let's say price is starting at 0 and doing a reversal. We take seriously the levels of 23.6%, 38.2%, 50%, and so on back to 100%. And then if price carries on, we can look at 161.8% and 261.8%. So what? If you've used Fibonacci on your MT4 charts, you will see that these ratios appear on the right-hand side of your chart. So here we have what we've created is a bear run on gold, and we've started at the top, which is the a bull run on gold, and we started off to the left side of the chart at around $1,298 and gone up to the top of the bull run which is $1,358. You say that price is out of date. This is a bit old. I'm showing you this now because I want to look at some slides that are pre-COVID. COVID not only changed our personal lives, wearing masks and hand sanitizing, it actually changed the way we look at technical analysis on charts. Every once in a while, we get either a flash crash or a black swan or whatever you want to call it. COVID did just that. It can seriously mess up technical analysis. So a lot of the slides I'm showing you now are very much pre-COVID, and actually from a video that I did for Valutrades on Fibonacci. So you can find that on the website. So here we have at the bottom of the screen, I've zoomed in the 100% level, retracing back to 61.8, 50%, and 38.2, and 23%, 23.6%. So, right, so these Fibonacci levels are basically, and as I'm going to repeat this over and over again, are really nothing more than support and resistance. They're not magic. Again, Fibonacci is simply a graphic. It's not calculating any mathematical prices. It's not looking at the speed of or volume of pricing and changes. It is simply plotting lines on a chart. And again, I'm going to share the secret. Why does it work? Because it does. That's not much of a secret. And the reason it does is because a lot of the big players use Fibonacci, the banks, hedge funds, even deliverables. When I say deliverables, I mean people like Thomas Cook and those people who you go to the kiosk for to change your money. I've spoken to many people over the years, whether they're in professional trading or whether they're running a hedge fund or whether they're trading their assets in a deliverable company. They will very often use Fibonacci to see where they are. And it's not necessarily to find out where the reversals are. It's actually, you can actually use this to create stop losses. So let's say you want to go short on a certain asset. In fact, if you look at this chart, let's say you want to go short on gold at the 50% level, you might want to place your stop loss above the 38.2% Fibonacci level. So again, you're using Fibonacci the exact same way you would use support and resistance. You're using it to find a place to put a stop loss. I always say if there's no place to put a stop loss, it's not a trade. So Fibonacci can be a very handy way to use that. Okay, and here we've illustrated support and resistance on this Fibonacci level. Right, so how do we start with Fibonacci? Well, the first thing we need to do is to find highs and lows, swing highs and swing lows. So basically a swing high is a candle in a wick, which is higher, where the point of closure or the point of the top of the wick, the high is higher than the candles around it. And a swing low is the exact opposite. A swing low is the point, whether you use the close of a candle or the low of a candle, where it's lower than all the other candles around it. So you can see in this graphic, it's quite clear. The orange lines are drawn around the swing high and swing low. So we can actually simply use the Fibonacci button, and I'll show you that in a second, on your MT4 platform to drag on this case, a bear run from the swing high to the swing low. And here's what we get. So we've started at the top, dragged it to the bottom, and you can see that we have some very clear lines. And in fact, we've drawn the 23.6% Fibonacci retracement actually was a swing low before we even finished the bear run. And that is a critical thing to understand, is that these Fibonacci levels don't just appear on the or after the bull run or the bear run that we're charting. These levels will go back in time. They could go back days, minutes, years for that matter, and you will find they will repeat themselves over and over again. So in this case, we've drawn we've looked at Fibonacci on a bear run on Aussie yen on the 30-minute chart. Again, you can use Fibonacci on any time frame. Like anything, like any indicator or graphic, the longer the time frame, you'll find the more accurate it is. Some people don't like using indicators or even trading on the daily and 4-hour charts because they're impatient. As long as you have a plan and as long as you have proper risk management, you can trade on the 1 hour, 30-minute, 15-minute, 5-minute, and some like me who trade on the 1 minute. I don't often use Fibonacci on the 1 minute chart. That's for something different. But as long as you've got a plan and you're careful and you have proper risk management and you like trading on those time frames, then that's for you. You go ahead. So if we look at this particular Fibonacci retracement, and we say retracement because that's what it's doing. You notice the bottom line says 0%. Well, the idea is it's coming back from the 0% and hopefully heading back to the 100% or stalling on the way. So in this case, price bounced off the 0% Fibonacci level, which looks like about 88.5 yen to the Australian dollar. It roared through the 23.6% level. Again, this is a 30-minute chart, so within a matter of hours, it was through the 23.6%, even though that was previous support. And it again went through and stalled a bit at the 38.2, but you can see it hit the 50% level, came back to the 38.2% level, went up to the 61.8% level, and it stalled again at the 50 and the 38.2% level. So these were quite key levels on the journey of Aussie yen that day. In fact, that was over about, let's see, looking at about 3 days that took. Right. Another thing with Fibonacci retracements is Fibonacci extensions. If you compress the chart, you will see that once we get past the 100% level, we're looking at the next series of Fibonacci ratios, 161%, 261.8%, and then up to 432.6%. To be honest, once these get that high, you're probably looking at something else in terms of technical analysis, but it's good to know. And it's always interesting to see if these lines will plot back hours, days, years to see if they were actually useful in the past. So here we have our Aussie yen trade. Again, price went up straight up to the 50% level, bounced off, stalled at 38.2, came back to the 61.8% level, and then sort of stalled again back at the 38.2% level. So these were accurate levels. They were good to trade. Where you spotted the reversal is at the lines of the Fibonacci ratios, but that's not all there is to it. You need to be able to combine this with other indicators, trend lines, to make your decisions on trading. Don't just go as soon as it hits a line and bounces off, think you've made a trade. Okay, just to reiterate, these levels, even though we've gone past the point at September 22nd there, you will look and notice that these levels were previous lines of support and resistance. We had at the 50% level, we had two areas that were clearly lines of areas, of supply and demand. And as I mentioned earlier, the 23.6% level was obviously beforehand a good line of support. So it doesn't have to be after the fact. And in fact, if we go back in time, and here we are looking at a chart, a 1 hour chart on pound dollar, you will see that these lines of support and resistance will repeat themselves over and over again. So Fibonacci is not uncommon to general lines of support and resistance. In fact, if you look at the 23.6% based on this bull run, which ended around the 18th of July here, support and resistance repeated itself at the 23.6% level 1, 2, 3, 4, 5, 6, about 7 times, and resistance at the 38.2% level several times, let's say 5 or 6 times, and support again. And we had a beautiful bounce off the 61.8% level, which was support. So you can see how valuable these lines can be. They're not just made up numbers. And again, a lot of the cases where we have reversals is because the big players are changing their tack. They're suddenly we've got a bear run on cable. Price came down and hit $1.293, which was a 61.8% Fibonacci level, and price reversed. And very often the reason price reversed is because the banks have orders and the hedge funds have orders placed at these levels. They've said, okay, we've had enough of our bear run. We're going bullish now. Thank you very much for the bargain. We're getting in. And there's absolutely no reason why these banks, and they do, and hedge funds use Fibonacci to plot these levels, because it's highly likely these levels were lines of support from the past, and they would have had their orders placed at these levels. Okay, if we carry on, in fact, if we look here at this retracement, and again, we use the word retracement because that's what we're looking for, you can see the yellow line where price retraced back to the 0% of this particular run, and you can see where a double top occurred. Price broke through support and then moved right back down to the 23.6% level and bounced off again. So here we were combining a chart pattern with a line of, in this case, a line of support, which was the neckline of a double top. Okay, I spoke briefly about using Fibonacci with another indicator. Well, if you follow my webinars, classes, videos, you'll find that I'm always using the stochastic oscillator. Hand on heart, full disclosure, it is my favorite indicator outside of the simple line of support and resistance. So here we have three cases where we're looking at gold on the 4-hour chart, and we had a retracement onto the 38.2% level. So what if we used, we can see actually we have on the, if you look at the 13th of September reversal, the very first one on the left, we had a doji and we had a bearish engulfing candle, and more importantly, we had stochastics showing us overbought and then moving to the downside. So if we combine those three indicators, Fibonacci with the line of resistance, the stochastic oscillator, and the candle pattern, we definitely had a good reason to go short on this. Again, we would have ridden that trade for being 4-hour candles, a good 12-16 hours, and we saw then the price came down and hit the 61.8% level. Well, so what? Again, using the this doji candle right in the middle and stochastics crossing from oversold to the upside, we had another good reason to go long. Again, that is probably a counter trend trade. You may not want to do that, but don't forget, a counter trend trade on the 4-hour chart may not look like that on the 1-hour chart. So that's totally your option. If you do like trading with the trend, we can see that this particular one was trending down. So the final reversal off the 38.2 was a looks like a morning star candle. Again, beautifully, stochastics showed us oversold and crossed to the downside. And then we got into a trade that went on for, if you're looking at 4-hour candles, actually several days. If you got into this trade on the 15th of September, or during the evening of the 14th of September, you could have ridden that trade down to the 100% level, which would have lasted a week, and you would have made some very nice pips. So again, I'm reiterating the fact that Fibonacci on its own is quite amazing, but combining it with candlestick patterns and the stochastic oscillator is another way to confirm that you're going long or going short on a trade. So let's look at some practical examples. Let me switch screens here. Okay, so here we have our Valutrades MT4. And here we have a chart on oil. Okay, we talked about pre-COVID and post-COVID. Well, obviously now we're in post-COVID. So we're going to be seeing this this big dive on every asset we're trading for quite a long time. So let's take a look at Fibonacci right now. So on the toolbar, you can see where I'm clicking here. I've selected the Fibonacci retracement, and I'm going to find, as we said, in this case, the swing high and drag it all the way down to the swing low. Okay, and here we have a simple Fibonacci retracement. So this particular Fibonacci retracement from the swing in January of this year, and obviously we all know about the crash that oil had during the COVID uh, situation, we'll call it. And also we have this lovely little gap here that we were watching for many weeks, and we filled the gap. So we have a Fibonacci retracement of the beginning of the year to the bottom of the market, where let's call it the COVID market. Okay, so right, I've got a nice fat thick lines brown. Let's look at some MT4. I'm going to double click on this dotted line, which represents the actual bear run of crude. I'm going to right click and I'm going to go Fibo properties. So here you can actually take a look at your parameters. Here I've actually colored the line brown. You can actually color it green if you want, no problem. If you want it thicker or thinner, you can do just that. So as you know, now we've got green, a little bit thinner lines. As you know, anytime you change a graphic or an indicator in MT4, it will stay that way until the next time you go back and change it. So very quickly, and the other way to do it, of course, is to right click on MT4 chart, the active chart, select objects list, and of course, so we've got our Fibo, we edit it, and now we can do the same thing. So I'm going to go back just for sake of clarity, change it back to brown and put on a little bit thicker line. And it's only because I want you guys to be able to see what I'm doing. Okay, so here we have, as we mentioned, the crude oil on the daily chart. So we can see what happened after the 0% retracement. Price actually bounced back, and for a while, the 23.6% level became support. But you can see what's happening now. Price went up in June and stalled a bit around the $40 level, and then came back to support at the 50% Fibonacci level. And here we see a very lovely doji candle, which told us there might be a reversal going on. But you can see what's happening now. It's ranging between the 61.8% level and the 50% level. Okay, that may sound wonderful, and I'm going to go back and say, keep in mind, this is a fundamental trade. There's absolutely nothing wrong with trading oil right now on the technicals, but everything is involved with fundamentals with oil. Obviously, coronavirus has hit demand quite badly. OPEC are constantly changing their production guidelines. So crude right now is definitely a fundamental trade, but there's absolutely nothing wrong with looking at it from a technical standpoint. In fact, there are many traders right now who are wondering when to go long on oil again, because a lot of countries and oil companies need prices to be higher because they're not at the break-even level yet. $40.58 per barrel really isn't enough to sustain an industry, especially an industry like the tar sands in Canada, where it costs almost $80, I think, to produce a barrel of oil. So we talked about earlier getting involved in some other indicators. So let's put on the stochastic oscillator. And here we have, I made it a bit chunky so you can see it on the screen. I'll get on my crosshairs. And you can see quite clearly where the stochastic oscillator has definitely helped us make this trade. So we had back on the 9th of this month, we had price coming back to the 50% Fibonacci level. If we want to trade with the trend, which hopefully with oil is an uptrend, we wanted to go long here, and the stochastic oscillator was a brilliant indicator to show us exactly when to get in and when to get to confirm the trade, I should say. If you want to use stochastics on its own, you can see that we actually had a fall here from overbought to back around to oversold, and price beautifully tracked that. Now we're looking at stochastics going the other way. So we are still ranging between the Fibonacci levels. Again, it's a fundamental trade. So we need to keep an eye on obviously the 61.8% level is quite important to the world, and it's about $43 a barrel, which is quite important. And if we go back here, I'm going to draw a little box around this level. You can actually see that this was support at well, back when coronavirus was taking hold of the oil market. Let's zoom out to the 1 week chart. And you can see, and it's not magic, I'm going to put on a horizontal line on the 61.8% level. In fact, let's practice what I preach. Double click on this line and make it a bit fatter, just so you can see it. Okay, so what we talked about earlier was that even though we are looking at a retracement after looks like about the 19th of April when things calmed down, when that contract expired on crude, that horrible day for the industry. If we look back 2 years, 3 years, 4 years, we can see that the 61.8% Fibonacci level, even though it was on a bull run caused by COVID, was still a key level of support. And this is what I want to get across, how important Fibonacci is to the world of trading when we talk about lines of support and resistance. So it's not just a magical line that we drew with a graphic, it is a real thing. You can see where we are here. And if we scroll back, I'm going to turn off the scroll button. We can scroll back and see that we had this is back in 2015, support as well was at this level. And it was right around $43. So we always talk about round numbers as being support and resistance, which is obviously a logical thing. Okay, so again, we want to cover the basics on this particular chart. Fundamentals always outweigh technicals, and I want you to keep in mind that trading with Fibonacci on its own may be difficult, but using an indicator like the stochastic oscillator and looking at candlestick patterns can really help you in your trading if you want to use Fibonacci. Okay, so let's move on to the S&P 500. And what I'm going to show you now is something completely different. You may not have seen this, and this is a Fibonacci fan. Fibonacci fans are a bit tricky. They don't always work. Let's draw a line. And here we are with our favorite COVID trade. We've got the bottom of the S&P 500 at in March the 20th, March the 21st perhaps. This is a daily chart. And the height back in February. So let's say we want to chart this little bull run. To here. And again, it's a bit subjective, I know. But if we assumed that I think I've missed it. So we call this a bull run because the markets were finally coming back. The bottom of the Fibonacci, and you can see this beautiful doji here. Clear indication that the markets were uncertain and very good. Thank the gods of trading that the S&P 500 did turn around, and the Americans had the good sense to offer stimulus to the markets. So we're looking at a bull run from March 21st to about April the 30th. And we're drawing that there. So what we see here is the Fibonacci fan giving us lines of support and resistance, or trend lines, I should say, of support and resistance. So the 38.2% ratio became quite a clear indicator of that trend. 50% was a zone where we had supply and demand, but we can see the 61.8% level was a very good trend line for quite a long time, from let's say the middle of June up until the end of August. So Fibonacci fans aren't for everyone, but you can always, once you see a bear run or a bull run, you can always literally play around. And if you find that you're getting an accurate reading off it, then by all means use it. In fact, let me show you something here. I'm going to draw a little box around this retracement. You can see that price actually dropped from the 38.2% and stopped that day right at the 50% level. So if you were trading that would have been a good indication to get out of the trade. In fact, getting back to what I was saying earlier, you will notice that the stochastic oscillator stayed in the overbought position for many, many days. And finally, when it dropped, you saw a very, very steep drop in price on this candle. And this would have been around the 11th of June. In fact, it was the 11th of June. So here we are combining Fibonacci with the candlestick pattern, and we're also looking at the stochastic oscillator. So using our delete key, we can get rid of that. If we go to the 1 week chart, we can actually use the Fibonacci retracement, and let's take a little play here. Yeah, we can see that if we use the Fibonacci retracement from literally 4 years ago up until the height here before COVID, we have some support, but that may not be valuable to you, to be honest. So let's try it the other way. If we do a COVID trade, again, we can see that if we extrapolate these lines back, we can see that they were in fact lines of support and resistance from previous years and days. Okay, let's move on. And again, because it's a graphic element on MT4, you simply hit your delete key and it disappears. Let's take a look at cable on the 4-hour chart. So we have a long bull run starting in about the 26th of June. And that ended just this month, the 2nd of September. And you can see how important these lines were. So we are looking, when I say retracement, obviously we're looking bearishly at the pound. And of course, pound again is a fundamental trade with Brexit going on. There's no doubt about it. But if you look at these lines, the Fibonacci retracement lines, they actually create very nice channels of support and resistance. So we bounce off the 0% back in the beginning of September. And we had price coming back twice to the 38.2% level. And this became a good line of support, dropped down to the 61.8% level, which has been a good line of, resistance. And this is now a good line of support. And we stalled right here. We are right now just around the 50% level. So again, if you want to trade pound or the cable or any of the pound crosses using, let's zoom in a bit on this. And again, we can see clearly that the stochastic oscillator is really helping us determine when to go short. In fact, here we have, if we wanted to trade off the bounce off resistance on 38.2, we have, again, a candle, which is a doji, another bearish candle. And again, we have stochastics turning from overbought into the sold area. And again, not that you would do this going long during a downtrend, you had the signal as well. But what you had more importantly was if you were trading the short with the trend, you had an excellent signal as to where to close. You had stochastics closing up, and you had price hitting support at this Fibonacci 50% level. Okay, let's go back a bit. Let me just zoom out a bit. Okay, again, if we want to go to the fan, we can take a look at this particular, and what I've done, I've gone from the swing high to the swing low. And again, it's quite subjective. You could actually go to this swing low here, which would have occurred in the beginning of September. And you could see that the 61.8% level actually became a trend line, and the 50% level became a lower trend line. Again, it's there for you to play around with. It's not easy trading Fibonacci fans. Okay, we've got a question. If you can't see this on your MT4 chart, let me show you where to find it. If you right click on your toolbar and go to customize, you can find all of your graphic elements there. So if I put this Fibonacci fan back, you'll find Fibonacci fan on the left side available. Click insert, and you will find that the Fibonacci fan or any indicator that you would like is now on your toolbar until you decide to take it off. Okay, let's take a look at gold. Again, on the 4-hour chart. We like to trade, we like to show the 4-hour chart because it's certainly less noisy. A lot of retail traders don't like trading the daily charts. The 4-hour chart gives us a very good view of short-term and long-term price action, and it's far more interesting. Let's face it, you wouldn't be trading a lot if you found it boring. So we want to keep things, keep it current and keep it interesting. I don't want to be doing webinars showing the 5-minute and 1-minute chart because the information will go stale quite quickly. So you can see on gold, I mean, gold is very clearly now a fundamental trade. We know that gold has been up and down based on obviously COVID and everything else. So in fact, let's go back to the daily chart. I know this is not particularly about COVID, but what I want to do is to highlight something that's quite important. We talk about gold as a fundamental trade, as a safe haven. When the world has bad news, the price of gold goes up. So if we look at this COVID drop, you're going to be asking, why did gold go down when COVID hit? Well, the reason is, this is completely contrary to what you've been led to believe in terms of the way gold trades, is that many hedge funds and banks lost a bundle on their equities and their forex trades. They had to liquidate their gold holdings to create cash to keep their clients' portfolios floating. So gold was sold quite a lot during the COVID crash. So the reason it went down wasn't actually for fundamental reasons like wars and US-China trade relations, et cetera. It was the fact that the market sold all its gold to pay for the COVID problems. And you can see that after that, gold came back up. So the bottom line with gold fundamentally, normally, is that when we have bad news, gold goes up. When we have good news, gold comes down. But we had a contrary situation here during COVID, and that's not much to do with Fibonacci, but I think it's important that you understand why price dropped so badly during the COVID crash. So let's take a look at gold from a Fibonacci standpoint. So we'll take the low point to the high point, and you can see quite clearly that we are right now, we have just bounced off a 61.8 Fibonacci level. So if you were trading Fibonacci on gold, you had 1, 2 bounces off support very recently. In fact, we're talking in the last few days, this being a 4-hour chart. And if you wanted to go long on gold to bounce, and again, you can see, I know I'm sounding like a broken record, the stochastic oscillator was a beautiful confirmation tool to get you there. And again, if you can see, let me zoom in a little bit, you can see the candlestick pattern helped us as well. We had a doji here, which told us that the market was indecisive. Again, we came back and we had another stochastic movement to the top, and we had a clearly had a bullish engulfing candle. So again, using Fibonacci with another indicator is always a good idea. If we go back to this retracement, and again, here we're trading with the trend, which is always good. We had a bounce off the 23.6% level. Again, candlestick pattern showing us a clear reversal, stochastics showing us a move from overbought down into the sold territory. Again, so we had a triple whammy, bounce off resistance, stochastic oscillator, and the candlestick pattern. So I'll zoom out again. Oops, zoom in, sorry. Okay, you're probably wondering why just stochastic oscillator. You can use any indicator you want, to be honest. You can combine it with Bollinger Bands. You can combine it with this another oscillator like the MACD is very popular with many traders. So if we use the MACD to take a look at possible movements. So here we had, for example, here's this bounce we talked about. MACD would have given you that indication because the histogram moved away from the moving average on MACD. I just find it personally a bit too slow for my liking. I would have wanted to get in sooner, so I used the stochastic oscillator. And here we have again this bounce off the support at 61.8% level, whereas the histogram crossed above the moving average on the MACD. So here we had an indication that price is going up. So whatever indicator you like to use, definitely use in combination with Fibonacci. Okay, so let's do the same thing with our Fibonacci. I'm going to show you one more thing on the daily chart. I tell a lie. Let me go back. Sorry, let me go back. I just wanted to see something on the COVID crash. So if we take the Fibonacci retracement from the COVID crash, we can in fact see that we had the Fibonacci extension is where we are now. So even though it was a black swan event, a very fundamental event, Fibonacci showed us that the extension does work. So at 161.8%, and these are a bit rare. I mean, you don't go looking for these very often, but it's interesting to see where they are when they do occur. Okay, we looked at oil, so let's look at its buddy dollar CAD. And I say buddy because if you've been trading for any length of time, you know that the Canadian dollar is seriously affected by the price of oil. So, and lately we've had a fundamental strengthening of the American dollar. So with the low price of oil, and if you caught my video this morning, we talked about this, the low price of oil and the strong American dollar has made dollar CAD go up recently since the end of all this month basically. So we're looking at the daily chart on dollar CAD. So we'll take it from this bullish run, which again was the COVID run. Okay, and we can see that the price actually came back to the 100% level, and we found that the 61.8% level was a key level through here. And what we also had was the 50% level showing us trying to be support anyway. And I'm going to draw this. We always drawing triangles, so it actually helped us point out this descending triangle. So Fibonacci was quite key at this key level at $1.89. So I can use my delete key to and again, if we take the Fibonacci fan, try to spot a high point and a low point, which was easy to do with dollar CAD. So the high point of the COVID crisis, again, strong American dollar because of the equity sell-off, weak Canadian dollar because of the price of oil, and we had price come back to a decent level of $1.32 back in June. If we draw a Fibonacci fan, we can clearly see that the 38.2% level became a trend line even before the finish and became a very nice trend line for many weeks to follow into the beginning of September. Now we've had price crossing up, so it will be interesting to see whether price actually reaches the 61.8% Fibonacci fan. And again, we'll keep an eye on our stochastic oscillator to see where that's going. So again, here we are using the Fibonacci fan as looking for trend lines, and it's interesting that it works. Again, they're not easy to find. You may or may not want to do that. You may simply just want to draw trend lines. There's nothing wrong with that. I draw them all the time if you watch my videos. That's another option, the Fibonacci fan. So let's take a look at Aussie dollar. On the 4-hour chart. So we're looking at a swing low back in June and a swing high in the end of August. And you can see quite clearly that price really liked the 61.8% level. And again, I'm going to zoom in a bit. We can see as well, even before the end of this bull run, that this Fibonacci level was quite important. And in fact, as we move on, we can see the 50% level as well. And we have a lot of support, incredible amount of support at the 23.6% level. Only once did it try to break through, but you can see that price stayed at that level, which was about around 72 and a half American cents to the Australian dollar. So what we're looking at right now, and this is critical with the Australian dollar, is a lot of traders are looking for a reversal, and you can see here that we might be forming a double bottom with the low points at the 61.8% level. So let's zoom out a bit and see if that actually holds true. Yeah, you can see that the retracement worked as well. But let's actually look at some other lines of support and resistance. And you can see that the 23.6% level was good resistance in the beginning of January 2019. The 38.2 was also resistance back in April of 2019. I could go on and on. So again, I'm reiterating the fact that these levels of Fibonacci lines of support and resistance will carry on back. And here's a very critical one from the 61.8% level, which was a perfect line of resistance earlier in the year before, obviously before COVID. But right as we finish the Santa rally. Okay, I hope that's been useful. I've enjoyed talking to you about Fibonacci. If you have any questions, please feel free to pop them onto the question on the chat line, and I'll be here for a few more minutes and be able to answer your questions. So if not, this recording will be available, this webinar will be available as a recording on the Valutrades website, and we'll be sending out some emails when that's available. So again, any questions, just pop them onto the question or the chat line. Okay, that's it for now. Okay, we'll see you for our next webinar. And if you have any things you'd like to see on the webinars, please send Valutrades customer support, your representative, an email. And we're certainly open to answering your questions or putting on any webinars that you would like to see. All right, thank you very much. I've enjoyed this, and we'll see you next time.